Hi, this is Chad. Welcome to the presentation, Saving Like the Wealthiest. This is a high-yield savings account that gives you a loan while also paying you interest. I'm going to show you how to get a loan for a Tesla and earn interest on that loan at the same time. And this works for any car, not just a Tesla. I just like Teslas. A private vault account is basically a prepaid line of credit where you are the banker and you are the borrower. You can write checks off the account. This is a picture of a colleague's client. The account holder purchased a car. Just over $30,000 was the purchase price. Well, it took just over a calendar week for him to open the account up, transfer his money from his banking institution into this account, then pull the money back out of that account as a loan and purchase the car. By borrowing the money out of his whole life policy, he saved about $4,000 in interest payments while he was still earning interest. And this is where the fun begins. We are going to borrow against the cash value of your account, but we're still going to earn interest on that account through the power of arbitrage. A common example of arbitrage is a landlord making a $1,000 mortgage payment and charging $1,500 in rent to the tenants. That amount between one cost and another, that's what we're interested in here. That $30,000 that client paid for the purchase price, he's actually paying $34,000 if he gets a loan from a bank. You could be earning the extra interest inside your own savings account instead of paying it to a bank, and this is done through the power of arbitrage. Buying a car with a bank loan is the same thing as investing in a depreciating asset, and you really can't afford it. This private vault account appreciates in value as you make major purchases out of it over time. Now, this is an example of a 44-year-old buying a $50,000 vehicle. Now, all these numbers on this chart might look confusing, so just pay attention to the highlighted numbers. The ones in yellow, that's the cumulative premium, how much we've put in as deposits. In green, the net cash value, how much we have access to. And then in blue, that's the death benefit. I know we don't care about the death benefit right now, but it does play a factor. First off, we're going to transfer $62,500 from our institutional bank savings account or wherever we are warehousing our money into a whole life account. You get access to this money shortly after you open the account. That is really the big benefit of leaving savings inside these over CDs where you can't touch it for a while. But with this account, you can access around 90% of it right off the bat because you are a member of a mutual company. Much like how a credit union has members, so do mutual insurance companies. And as time goes on, the account holder will have access to much more than they put in. But starting out, if he puts in $62,500, he can access around $50,000 or so. Then we take a policy loan for $50,000 and we buy the car. Over time, we pay interest on that loan while earning interest at the same time on the bigger amount at a higher rate. So he withdraws the maximum cash value limit and he purchases the vehicle. At that point, he would have a loan from his life policy at an interest rate somewhere between 1% and 4% most likely, and at the same time he's paying back that loan, his account with $62,500 is appreciating at a higher interest rate, maybe somewhere between 4% and 6%. And with arbitrage, you're still earning a few little extra percent on your savings in there, and it helps to stay up with inflation. The borrower saves $1,250 a month after transferring the original $62,500 in and took about $50,000 out. At that point, the $62,500 starts that lifelong cash flow that a dividend starts working off of, and then it becomes a high-yield savings account. Now, over the next 5 years, the policyholder ends up putting in just over $137,000, and throughout those 5 years has had access of up to just right under $130,000, which is almost as much as he put in. If you were to close this savings account down right now, you would not get as much as you put in. But why would you close this savings account down? Look at what happens in another 5 years to your savings. That's when it starts to get really fun. By year 10, you've saved around $205,000, but your account has earned $15,000 in interest, about 7.5%, or about 0.7% average over the entire 10 years, but that's still better than a bank savings account. Over the second decade of the account, when you are 15, 20 years older and you probably need more money then, it will be there for you in a really big way. And this illustration shows the account after 20 years of saving just over $333,000 is worth over $477,000. Now that is done through the power of compounding interest and the beauty of arbitrage. When you need to access your savings for major or consistent monthly purchases, you take the money out and you put it back in. And as an extra bonus, the whole time there's a death benefit. So if the account owner gets hit by a bus, their family or their heirs get over $1 million. At age 65, $1 million term life insurance costs much more than the $1,250 a month he's putting into this account as savings. And that's why term life insurance is bad over time, because you don't get a refund if you live, and term life insurance gets more expensive every day because you're getting older. So in this case, $15,000 a year or $1,250 a month putting into a savings. It's better than putting into a savings account at a big bank where the only potential to earn is 0.03% a year. And not only can you do this with a car, you can also do it with your bigger monthly household purchases, like paying your mortgage or your property taxes. In this example, we transferred $30,000 at a big bank, earning basically 0% interest, put it in to the whole life policy, and now once the account is open, you start paying your monthly mortgage and your car loans and all of your bigger debt. In this example, repeating that cycle of continually saving $5,000 a month inside the account and borrowing out of it for the expenses and then paying the policy loans back allows that compounding interest and arbitrage to really go to work. After 30 years, when the account owner is 75 years old, you've saved almost $1.8 million, but you have a net cash value of over $3 million to draw off of. And that is with a $4.6 million death benefit to your family and heirs if you unfortunately pass on at that age. So why would you waste money on term life insurance when you can just put it all in together on this whole life policy? There are no early withdrawal penalties. Loans from dividends and premiums are tax exempt. The loans from 401ks do not receive the arbitrage dividends, and deferring those taxes actually makes the government your business partner in the future. Where and how you save your money now at this exact moment in time will affect your future very, very directly. And if you're a business owner, you should have at least 3 or 4 of these accounts, and they're great for employees' retirement accounts. Ray Kroc ran McDonald's real estate holdings through these. Walt Disney ran the cash flow from the happiest place on earth through a life policy. And J.C. Penney ran portions of his business expenses out of the life policy. But don't worry, you don't have to be a titan of industry or super wealthy person to take advantage of these programs. If you're a small business owner and you're innovative, we can design one of these policies to help run all of your assets and capital through. If you're the head of a household, these are still great. If you lease equipment or vehicles, these are perfect. It's just a lifelong piggy bank with more benefits than a savings account at a bank could ever match. There really are so many things that you can do inside these policies. You can finance vehicles, real estate, property taxes on the real estate, start a college fund, finance your business inventory and procurement needs, or the assets and the business equipment. All of this stuff can be done through the policies. And that's it. That's the presentation. Saving like the wealthiest. What we need to do now is find out what your short and long-term savings can look like inside a private vault account. Let's schedule a time.